that's my working title, and I am going to get to that. But I wanted to cover a few things that I think are quite important before I go on to, excuse me, this seamless integration and the self-promotion of our material. It's often useful to go back and just consider what the issues are when you think about responsible investment. And these are the three pillars. We have environmental, social responsibility, and corporate governance, ESG. We've been sweeping broadly across the three of them without really distinguishing what they were. But it is worthwhile thinking about just what they are. Environmental, climate change, resources, waste, all the things that I think accrue to us as humanity. Social responsibility, community responsibility, human capital development. We're not hiring people under the age of 13 in less developed countries. Product and service quality and associated opportunities. That's sort of a halfway house between socially responsible, let's do the best thing we can for humanity and consider ourselves as just individuals, and maintaining some vigilance on the correct practices of the companies, that they're serving the community and that they're monitoring the integrity of their products. Corporate governance is different again. It's corporate behavior, financial responsibility, controls, board accountability, ownership and controls, poison pills, remuneration, shareholders' rights. I don't think anyone in a less developed country would immediately go hungry if we found that there was a chairman and chief executive that was the same person on the top of Google. I think there's a difference between public benefits and private benefits, and I think the distinction between E, S, and G is really quite stark, and we've been grouping them together, I think, incorrectly. What's most practiced? I mean, our business serves about 350 investing institutions around the world, and we've also, I mean, I've been involved in the investment business. I remember when I worked at Hermes, our chief executive was kicked out of an annual general meeting for asking an embarrassing question. And I thought that was one of the first days of corporate governance. He was very proud of it, actually. But what do you think is the most widely practiced, whether it's environmental investing, socially responsible issues being observed, or investing in companies displaying corporate governance? Well, I can tell you from our own experience that one of them takes priority, and the second one takes less priority. But I don't even have to say that. I just have to say that when ISS sold to Riskmetrics, it was for $550 million, and ISS does corporate governance. I know when TrueCost is recapitalized, or when KLD is acquired by MSCI, the figures are much, much less. So we know that corporate governance is far more adhered to in the city than social, or observed in the city, than social responsibility or environmental investing. And it really goes almost in the reverse order. Now, this is probably the reason when people think of corporate governance, they think of it as an indicator of sound management. It's linked to the success and profitability of a business. And it's a bankable, or it's a potentially bankable commodity. Social responsibility talks about the role in the community, staff and personnel. These are good because they train staff, and staff are going to be more loyal and perhaps more productive. And there's product integrity monitoring as well, which is also then linked, at least in part, to success and profitability. And environmental considerations, well, it's a cost with a questionable payoff. The benefits are more likely to accrue to the community as a whole, but they're not bankable by an individual company. And this is the way some people think. I'll answer some more questions on investment managers' considerations, perhaps in question time. But I think that's the way that most managers would think. And it certainly explains the difference between the pricing for an ISS type commodity and an environmental provider of data. So I wanted to at least show some preliminary evidence. In order to actually get beyond the hand waving, I thought, well, let's do some semi-serious research. Now, I'm being a little bit brutal here, and perhaps in some ways I'm being a bit unfair, but I'm being a lot fairer than I think most. What I've done is I've taken, in the UK I've started, and I've taken quintiles rebalanced every 3 months, and I've taken, ordered all the stocks that have the data. I haven't made any errors, including stocks that don't have data with those that do have data. I've ordered them in sector-adjusted terms, so the high quintile on these sectors and the lowest quintiles do not have big imbalances with financials differing from the environmental impact of oil and gas sectors. And you can see in the United Kingdom, the companies with the lowest quintile, there's too many sort of light blues, but it's this one. That's the lowest quintile. That's the lowest 20% of carbon GHG emissions, has over the period of the data, it's bounced around a bit, not as badly as others, but it has outperformed. Let's take a look at. We look at social responsibility, and this is risk metrics, which was ISS, which now MSCI. And we have, again, the highest quintile has done best. It's, again, waved around a bit. It doesn't quite fan out. I mean, in order for this to be really academically supported, you'd want it to fan out so that the highest would be quintile 1, and then the second highest would quintile 2, then 3 and 4 and down. You never find things as easy as that when you actually look at the numbers. But it's reassuring that the top 2 quintiles have outperformed. So socially responsibility outperforms in the UK. It's a regulated and very strongly monitored market. And in the same way, corporate governance, again, it's had a flip in around 2009. I'm not sure what that was due, but the highest quintile and the second highest quintile also outperforming. So that's quite an interesting situation. It seems like, what was that? Good pays off?
What you mean by the quintiles there? What
yeah.
represent exactly?
Okay. I took all the stocks in the market and I ordered them by, well, in this case, corporate governance. We get a statistic from GMI on this. We get a variety of statistics. This is just a broad statistic. And then you count down until you get the top 20% and the next 20% by market capitalization. So the number of stocks in each quintile will be different, but the market capitalization will be the same. And I'm just monitoring the performance of those portfolios relative to the performance of the underlying market. Now, it's a bit brutal, but 20% is better than just the top third versus the bottom third. And you can see whether there are things that come out. But again, that's only in the UK. So I then decided to do a similar analysis, looking a little bit more broadly. So I looked at the US, the UK, Japan, the Eurozone, the world. That's about 76 countries, I think. No, it was 115, I'm sorry. Then the world developed, which was 24. The emerging markets and Asia-Pacific ex-Japan. Now, there's too many numbers here, so I'm just going to try and highlight what I think is relevant. Okay, this is E. And what I'd already spoken about is E in the UK. And what I'm showing are the performance of the top quintile, or the best quintile. It's the top for S and G and the lowest for E. So it's the good versus the bad. And red means it's positive, it's warm. That's what you want to see. So you can see that it has outperformed. That's basically what I was showing before. But what's interesting is the same situation in Japan, the same situation in the Eurozone, the two worlds, the emerging markets, and the only areas where it's not the case is the United States and Asia Pacific, but it's not dramatic, so I've marked those in green. So that's the E. Now, if I go on to S, this is social responsibility, how you would do were you to invest in companies that had a high score on the social responsibility index from MSCI, it's the ISS statistic. Then there are the UK still, Japan, Eurozone, and the emerging markets, but there are some now which are clearly negative, and Asia-Pacific is neutral. So that's not as good. And you go to G, which is corporate governance, what you would do, how well you would do over the past 5 years if you were buying companies that had separated the role of chairman from chief executive, had a poison pill that the shareholders had agreed on, subjected themselves to audit, all the things that we believe are going to provide assurances of performance. It's only in the UK. That's quite interesting. Now, as investment managers, we were often taught when we put a presentation together that we talk about the 3 Ps, and the 3 Ps are the people, the philosophy or the practice, and the performance. And so I kept it to the 3 Ps, but I'm talking about what's right for the planet, what's our actual practice, and what's the performance. And I think what I was saying earlier, that for the planet, we all benefit from environmental containment and sustainability. We also all benefit from a feeling of social responsibility when we find that companies aren't employing people under the age of 15 to do horrible things. But I don't think we really benefit or feel much about our personal identity and sense of personal responsibility when Enron goes bust. So corporate responsibility is at the lower part for the planet. In terms of the practice, it's the other way around: corporate governance, social responsibility, and the environment. But in terms of performance, we saw the way the orders of relevance changed. It's back to the environment, social responsibility, and corporate governance. Now, in keeping with the ecclesiastical history of St. Andrews, which goes back to around the mid-1100s, this is tantamount to a proof of the existence of God. Despite what we do, the performance matches what's right for the planet. And it sort of reminds me of there's an old Yiddish expression that probably doesn't go back until the 1100s, but it says, "People make plans and God laughs." And this is, at least when he's laughing, he seems to be benevolent. So, maybe enough about that too. But
does it say something about the fallibility of man?
Yes, that's right. The fallibility. Yeah. I don't want to give too damning an analysis of the ESG, so I did look a little bit further, and I said I was looking a little bit brutally across all the criteria, and these groups of 20, 20, 20, or 20, 20 are really a little bit too tight. When you speak to people who are describing the usefulness of corporate governance or social responsibility data, they say it avoids the disasters, and 20% is probably too broad a category and mixes too many things in within it. But I did look a little bit further within the United States just to see whether there was anything worthwhile, and I broke out the statistics that relate to the broad categories of corporate governance. I hope you can read it. This one is audit, board, the composition of the board, remuneration or compensation, and then shareholder rights or shareholder protection. And you can see that at least in one in particular, shareholder, it's absolutely correct that the best thing to do is to invest in companies in the United States that protect shareholder rights. Now, when you're thinking about it, I think what I've wanted to go on to now is just trying to show how it would be possible to make inroads in the investment community. Perhaps in question time, I'd like to respond to a question about what do managers really think. But having been one for more years than I can remember, I think I might remember a bit. But you need something to show them. Otherwise, it's not an issue. And this is a worked example. I don't think he would mind. This is Neil Woodford's fund. It's nominally it's about £8 billion in terms of the other investments that are run to the same methodology. Some say it's about 25 to 30 billion. So it's by far the largest in the UK. It's got a terrific performance, and, well, it has really. And people wonder what's within it. So we went through this, and I'm sorry for all those who were in the study group. There is some duplication. This is just showing how he compares against the benchmark. He's got a slightly higher carbon footprint. It's positive on social responsibility, negative on corporate governance. Just go through a little bit on it. If you adjust for sector imbalances, we all know that Neil Woodford is massively overweight in tobaccos and the consumer stocks. He's completely underweight in oil and gas, and he has big positions in the utility sector to achieve his dividend. If you unwind all that and say, well, what kind of stocks is he buying within the sectors that he's holding? You get it. Look, he looks as though he's got a high carbon footprint. Let's just look at the carbon footprint for a moment. And yet, when you look at it, you can see that in terms of the actual distribution of where his money is, those companies with the high carbon footprint, the higher 80 or the top decile, he's got an underweight position, and he's overweight the small cap. The reconciliation of this is that he has a number of stocks, at least one, where there is a shoot the lights out GHG pollutant score, a carbon footprint. But he hasn't got very much money in that sector. Now, we went into that in further detail, and you can actually see it's a consequence of one company, and that one company is actually improving its situation as progressively as the years go by. So you can look at it. Now, you can also start to analyze managers' performance, and I think this is where the Achilles heel, or at least you get to managers through their vanity. And here we've got it. The blue line is his outperformance, his active return. Since I was doing this in terms of carbon footprint and the greenhouse gas effect, this is his allocation to the greenhouse gas quintiles that we identify. And it's positive. And stock selection, which is the green line, is positive within that. So it's a very good story. And if you go into the detail behind it, you can see that this is his average position. Over the entire period, he was underweight the very high pollutants, which underperformed, and that gave him a benefit. These, again, are average positions, slightly overweight here, outperformed. Underweight here on average in the very low sector, which underperformed slightly, so that was good. So his allocation to carbon emissions was positive. And this is where I think managers can start to really blow their own trumpets. And that's, you can talk about your skill within each area. Within companies where there is a low carbon emissions, he was very good at stock selection. Now, this gives a manager the ability to get into something and talk about it with some pride. I think perhaps in view of time, and I think I have gone on a bit too much, I'll stop. I was going to go in the position on social responsibility, where there is also something very positive to say, but I think the general conclusion...
I think we can stretch the time a little bit.
Pardon?
Stretch the time a little
bit. Yeah. Okay, well, I just... okay. This is a similar situation where you saw, again, outperformance on the basis of his allocation to social responsibility. And if you go into that, he was extremely high, very positive on companies with high social responsibility that paid off, and underweight companies with poor social responsibility, which also paid off because they did badly. And his stock selection was good. So this gives you something tangible. Now, this is something new, and I'm afraid that, unless you ask for the PDF on it, you probably won't be able to read it at all. But it's something that our company has started to do, and that's monitor mutual funds. And this represents the monitoring of about 600 mutual funds for which we can get data. And we're looking at them in terms of social responsibility, the total impact, environmental impact, various types of corporate governance, and the carbon footprint. The top section is dealing with the allocation, and just to interpret here, this is on the total impact I'll look on this. This is sector adjusted. This is saying, in allocation terms, most managers get it wrong. A few have got it right, but there's a wide area where managers can get poor results or bad or good results. This is in terms of the allocation effect, and this is in terms of the stock selection effect. And what we're now encouraging managers to do with us is to request that they be, we call it in the office, pin the tail on the donkey, to be able to identify where they are within this band. And it gives them an ability to describe themselves using these criteria in a way which hopefully they'll be able to say they look good. I expect there'll be it's a bit of a self-serving, self-selected group. Those who fall below the line won't show it, and those above will, but it'll take time. Okay, conclusions. ESG factors do impact on performance, both for securities and portfolios. Managers can be analyzed. I think we've shown that. And my belief, and at the moment it's just a belief, but I think it's at least an experienced belief, that with analysis now more widely available, ESG behavior can and should become a routine reporting requirement. Okay, thank you.